Hello everybody, welcome back to my channel. We are still going on with our lectures on VAT, and here's exercise case 26. Again, we are going to practice a bit our until now still basic knowledge of the things which go on for deliveries within the EU in a cross-border case. Well, the first thing we should probably do is read the case which we have to solve. So here's the story of exercise case 26. It's about E from Essen. Essen, is a city in Germany, for example, in the Ruhr area, where you probably remember there were all these steel factories, and Essen was the main seat of the famous Krupp farm. But all that doesn't matter for our case. It's just E from Essen, and that E receives an order from customer F in Frankfurt. That's also in Germany. However, now that would be a very uncomplicated thing, selling something from Essen to Frankfurt. Now we have a complicated customer. F insists in that E doesn't bring the product to Frankfurt, but in order to save time and transportation costs, he says, I want you, E, to bring the goods in question, which I ordered, directly to the address of my own customer, M, in Madrid, in Spain. So E does it, and M then hands out his Spanish VAT ID number to E from Essen when he delivers the goods. F, the customer from Frankfurt, has only a German VAT number on his order forms and business papers. So that's not everything, because before E now can deliver really and can go to Spain with that, E finds out I don't have the product in question in stock, so I need to buy it first from a producer in Basel, Switzerland. There, a price of 30,000 is agreed, a net price plus correct VAT amount if any arises. The Swiss producer so brings the product to Essen, Germany. There it is handed over to E. The Swiss producer, on the way from Switzerland to Essen, paid the German importation VAT and the border. And there, after some days, E then began to carry the product to M in Spain, and he did it by using an own truck. That was very benevolent to us, because otherwise, if he had employed a forwarding agent, a haulier, or something like that, then there would also have been a service for which somebody would have to pay, and then we had another transaction within the case. So let's be grateful he uses an own truck. That simplifies life. Immediately afterwards, when he is back after doing the delivery to Madrid, he charges his customer F with the following amounts: the contract net price 50,000, the packaging 100, the transportation service 1900, the road user charges Maut. That's the German expression for road user charge. Sometimes when you use a truck on certain roads in Germany, there is a state levy for the truck driver. And let's say it was 500, and he charges these costs to his own customer F because he did the travel on his behalf. So we arrive at a total net amount of 52,500. Then he computes a VAT of 10,500 and arrives at a famous final amount of 63,000. Now the question which we have to solve might also be interesting, and it's a very general one. It's what's the treatment for P in Switzerland, E in Essen, F in Frankfurt, and M in Madrid? So it's basically give your opinion, well reasoned and founded on legal references and exact rule and citation of the rules for everything what happens here for every person involved. And well, we are just going to do this just now. So let's first have a look what happens here. The first idea which probably comes to our mind is we see here an invoice which gives a long list of positions and things which have been done. So he does not charge only the delivery, but also he charges fees for the transport. So the first question which arises here is that one single transaction, or is it two separate transactions between E and F, so that we would have to investigate into the treatment of a sale plus the treatment of a service transportation? Or is it just a single and uniform transaction, so that we only have to deal with one case here? And you probably remember something is a unitary transaction which can't be split up into parts, irrespective of what the people write into their contracts. It's only one single transaction if an average consumer or average customer would not order these things normally from separate suppliers. So if economically it makes no sense to buy it separately. Now with selling goods, there must be always an agreement on where you hand over that good to your customer. And so indeed, it is not possible to separate a sales contract, whereby you sell something to a customer from the transportation of that good to the place where you have to hand it over under your agreement to your customer. It is definitively one single combined transaction. Then you probably also remember that in such a bundle, unitary transaction, there are core elements or main elements and ancillary elements. And the ancillary elements, these were those elements which the customer doesn't want to buy primarily for themselves, so because of these things, but customer is only interested in these elements because they make the core aspect of the transaction easier to perform or possible at all. And indeed, that's the case with the transport here to the place where the good has to be handed over. Nobody wants that transferred as such. Customer just wants the machine or product or what else has been ordered, and then having to bring it to the place where it has to be handed over is just a necessary consequence. So that is an ancillary element, and that means when we evaluate the situation, the ancillary elements are completely ignored, and everything what the customer pays under which pretext ever, even for an ancillary element, is automatically reinterpreted as being a part of the price for the main element. So with that, we can also already draw one conclusion. Here is only one transaction between E and F, and it is the sale of the good, of the product, which F ordered from E. Good. So the road user charges form part of that consideration, like anything else. If you have doubts there, then please review our small introduction concerning the tax base in the previous and first parts of the lecture. However, let's now analyze the contract relationships. What happens? We have a contract between E and F, Essen and Frankfurt. Then we have evidently a contract between the Frankfurt guy and somebody in Madrid in Spain. And as we have seen, E is also involved in a contract with P from Switzerland. And now when you want to reconstruct the time sequence in which these contracts have to be executed, then you find out naturally that P has to deliver first the good to E. Only afterwards can E deliver to F, and Only when that has happened, so when F has got the goods at his place where he wanted them, then F can hand the goods over to M. So the time sequence is what the numbers show. From where to where now moves this good during these transactions? In the first transaction below, then it seems to be clear that the good starts at Basel, Switzerland, and is brought to Essen because text says so. So the good crosses during that transaction the border of the EU. So there we have the red line here. Now transaction number 2, E to F. Here the contract requires that the good is sent from Essen, where it is at the moment, to not Frankfurt, but to an address ordered by F in Madrid. Because that's one of the nice natures of a purchase contract. The customer can decide where you have to hand the good over. That must not necessarily be his home address. You can also demand handing over at another agreed place, and he said bring it to Madrid, and he doesn't need to receive it himself, but he can also receive it by somebody who represents him legally, and evidently he did that. So the order was bring it to Madrid, to an address, hand it over to a person I name you, and then that's it, and then you fulfilled your delivery obligation towards me. And then the next thing is F hands over property, the ownership to M, and there the good is already in Madrid and stays in Madrid. So let's begin with chronologically the first transaction. That's the movement of the good from, or the sale from P to E in Essen, where the good moves from Basel to Essen in Germany. The first question is taxability, as always, and you know there are only two numbers which can interest us at all. That would be 1 number 1 and 1 number 5. 1 number 5 is only possible for intra-community acquisitions. Switzerland, Germany, that's nothing within the EU, so only number 1 is remaining, so 1 number 1 is to be tested. Just to remind you, 1 number 4 is here completely out of the question, because that is a taxability which is tested by the customs duties officials at the border, and that has already been done, because our case information says that P paid the importation VAT at the border. So the only thing which is still to be tested is 1 number 1. Let's test it. So P is an entrepreneur. P acts also within the scope of his enterprise activities. 1 sentence 2, everything which is connected to his enterprise is comprised by the term enterprise activities. That's clear from that. He does it not for nothing but for consideration. It's a delivery because a tangible good changes owner, and well, now we need the place of supply. The basic rule would be 3/6. That would be where the transport of the good begins. That would be Basel. However, for transactions where a good crosses from a third country into the inland, there is a special rule of paragraph 3.8. And paragraph 3.8 says, if the good comes from a third country into the inland of Germany, then I apply. And that's indeed the case, Switzerland to Germany. And additional condition that the VAT on the border, the importation VAT, is paid by the supplier. And that's also true. So 3.8 applies. Now 3.8 says, if I apply, the place of delivery is shifted fictitiously to the inland. So now we have 5 criteria fulfilled. Entrepreneur within the enterprise for consideration, delivery, and executed in the inland. So the transaction is fully taxable since all 5 criteria of 1 number 1 are fulfilled. Are there tax exemptions? The next question. Paragraph 4 does not apply, especially there is no export or inter-community delivery, because the good doesn't go out, the good comes in. Well, so next question is tax base. Here, the tax base is the gross amount minus the VAT included therein. You know all what the deliverer gets minus the VAT. Here, the contract says 3,000 plus VAT as gross amount minus VAT is then the net amount, so 30,000. The tax rate is 19%. At least we have no indicator that 12.2 with 7% should apply, or even 12.3 with 0% for photovoltaic devices. So 5.7. The taxpayer is the Swiss entrepreneur according to the normal rules. The arisal of the tax, or also called tax point, at the end of a preliminary declaration period from which the delivery was made, blah blah, always the same stuff. The invoice follows the normal rules. That is here a shock for the Swiss, because to issue a German invoice under the German invoicing rules, you need to have a German tax payer's number or value-added tax identification number from Germany. Without these registration, you can't issue a proper invoice. Declaration has to be handed in under 11 number 1 in Germany, so the Swiss also is now forced, if not yet forced to it, then forced by this transaction to hand in a tax declaration to the fiscal offices in Germany for value-added tax. Peculiar aspects not covered by the usual testing scheme, not here. And input tax says, well, the German customer E can claim the tax back as input tax if P confirms them correctly in a correct invoice. That's nice. And the Swiss deliverer then can claim the importation VAT back in his tax declaration on this transaction, which he hands into the German fiscal authorities, because that importation VAT is input refundable. That can be seen in 15.1 number 2. So that's everything concerning the transaction P with E. Now let's go to the second transaction. That was the sale of the good in question from E to F, and the good during that transaction moves from Germany to Spain. Please remember clearly, F was a customer from Frankfurt. However, customers are not obliged to have their goods sent to their home address. You can order a good to be delivered to every destination which you agree with your seller. And so F said, I don't need it at Frankfurt, I want to get it at Madrid. And there's somebody who acts as my legal representative. That will be my own customer M. There M will accept the good in my name. And so when you brought it to Madrid, handed it over to M, then you have fulfilled your delivery obligation towards me, F. So here the good then goes during this sale from Essen to Spain. So it crosses an internal border, and so we need to apply the rules which we have learned for EU internal deliveries cross-border. So the first step was always is the customer entrepreneur. You remember that. In that case, we have that solution: customer pays intra-community acquisition tax, and deliverer is tax-free if he can prove all the necessary proofs. And so we have to test that now. So acquisition tax is to be expected for F in the country of destination, that would be in Spain, and the deliverer probably has an inter-community delivery if he can prove the transfer of the good to the other EU country and can give the VAT identification number of his customer of another country. So let's check in how far that is true. By the way, both tax treatments are independent of each other. So if, let's say, the inter-community delivery can't be proven, then the intra-community acquisition tax obligation doesn't fall away. Then you have two people in problems, not only one. So to test is 11 number 1, And we have a delivery because a good is sold, so a tangible good changes the owner. The place of delivery is under the basic rule 3.6, sentence 1, where the transportation of the good begins. That's Essen, and there is no special rule which might apply, so that remains Essen, and so the other criteria are also fulfilled. E. The deliverer is an entrepreneur, acts within his enterprise activities, does it not for free but for consideration, so everything is fulfilled and the transaction is taxable in Germany. However, it should be tax-free as an intra-community delivery. Let's test this and there will be surprises. Number 1 is fulfilled, the good goes from Essen to Spain. Number 2, letter A is fulfilled, customer is an entrepreneur. Number 3, the customer will be subject to acquisition tax in at least one other member state. Yes, that is the case because the good goes to Spain, and we will see that the customer F will be subjected to Spanish acquisition tax. However, there is an additional condition which has to be fulfilled. The customer needs to have used during the transaction the VAT identification number issued by another member state than Germany. This is not yet fulfilled because in my case information, I just told you that F only used his German VAT identification number during the process because F, or an accountant of F, said, well, I'm a German firm, delivery is a German firm, so why do we need any cross-border things? So it seems to be an internal case. Now we know it is not. It is a cross-border case in the EU, and it should be a value-added tax identification number of Spain, which he hands over to deliverer E so that everything can go fine. He did not. So number 4, the last condition for the tax exemption, is not yet fulfilled. So not yet a tax exemption. So still taxable and liable to tax. It can, however, be made tax-free if if F later adjusts or corrects the information and hands out a Spanish VAT identification number to E. Or it might even be under a special rule, which we do not yet know, the VAT identification number of any other member state, which is not Germany. However, until that happens, there is not yet a tax exemption, so still liable to tax. By the way, that E has got the value-added tax identification number of M from Madrid does not play a role and is not helpful because everybody makes deliveries to his or her own customers. So you need the VAT identification number of your customer. That must fit. The VAT ID number of a customer or of any other person is the wrong one. You need a VAT ID number of your customer, and that's missing here, and so for this reason the matter is not yet tax-free. After such a correction later, then the transaction would become tax-free under 4, number 1, letter B, inter-community deliveries are free of tax, but until then it's not yet tax-free. Momentarily it's liable to tax. So we have then to compute the tax. All what the supplier gets here is 63,000. The VAT included therein should be 19 out of 119. So the remaining amount is 52,941.78. The tax rate and tax is 19%, and so the tax is 10,058.82. The taxpayer is the supplier, that's E. The tax arisal is when that preliminary declaration period, vulgarly called that month, ends during which the delivery was made. The invoice shall be simply normal. However, after a later correction, when F supplies a Spanish VAT identification number so that the matter becomes retroactively tax-free, then the new invoice must state no VAT at all, must contain a hint to the tax exemption, and must give the VAT identification numbers of both parties involved on the invoice. Declaration duties as usual. Peculiarity. As you have probably seen and then overlooked, he charged here a VAT amount of 10,500. However, we have seen that the correct VAT is only 10,058. So he overcharged VAT, and there something comes back to our minds, because if you confirm more VAT than is due under the law, then just because of the error, you also have to pay the extra amount. So here, E is liable for a complete amount of 10,500 until a correction of that invoice has been made. After later, perhaps a VAT identification number from Spain of the customer comes in of F from Frankfurt, not of M, and the transaction then becomes tax-free, then the change is a change of retroactive change of the tax base and of the tax. So that has to be reported under paragraph 17 USDG in the month when the change happens. And peculiarity is also that the recapitulative statement has to be issued then on the transaction, which is then an intra-community delivery. Number 7, input tax questions. F has no right to input tax deduction from this invoice, because the invoice E to F could have been made tax-free, and usually there is no refund of input tax when the matter could have been treated tax-free. In internal cases, so German to German, that's sometimes neglected. However, the correcter version would be this one. Well, let's go on a bit. We still have the other side to look on. What happens to F in Frankfurt? All over the world, so also in Spain. Taxability. On his side, it's an intra-community acquisition. 1.1 number 5 has to be tested, so let's do it. Most probably a yes comes out. He buys a good and orders the supplier to bring it to another member state, so to Spain. So we have a crossing of a border in the EU. Inter-community acquisition. 1.1 number 1 is fulfilled. The good goes from Germany to another member state, to Madrid. Number 2 is fulfilled. The customer F is an entrepreneur, and number 3, the deliverer is also an entrepreneur and is not a small entrepreneur. So we have an intra-community acquisition fully fulfilled. Place of acquisition. In which inland of which member state is it taxable? 3D sentence 1, where the good is at the end of the delivery, so in Spain. However, during the transaction he used a German VAT identification number, and so one can take the view that also Germany can claim that he taxes an intra-community acquisition here, until our deliverer proves that the acquisition has been correctly taxed in Spain. So it would be taxable in Spain and in Germany. A tax exemption. No exemption under 4B in Germany, and probably no tax exemption under 4B's parallel in Spain, because these rules are strongly similar everywhere. The tax base is everything which the supplier gets, 63,000 in this case, and minus VAT included therein. There is, however, no VAT included because acquisition tax has to be paid by the customer on top. So we end up with 63,000, and the taxes in Spain would be the Spanish tax rate on the 63,000, and in Germany, if Germany takes that view that they can charge a tax, then 19% on 63,000 would be 11,970. Taxpayer is a customer. tax arisal when the invoice is issued, but not later than at the end of the first calendar month after delivery. And well, that's nearly everything. Peculiar aspects out of the testing scheme. Well, the transaction, when the treatment is corrected by F, when he hands into E the Spanish VAT identification number, then probably also they demand back a bit of the money because the net price was 50,000 plus costs. So probably the consideration gross will be lowered to 52,500. Then also the acquisition tax will have to be adjusted accordingly. The input tax in Spain is recoverable as input tax under 15.1 number 3, or better under the Spanish parallel to this rule, naturally from Spain, because you can't claim input tax in Germany for tax which you paid for Spain. The German acquisition tax, if levied, cannot be reclaimed. 3D sentence 2 is a punishment tax. It is not an input tax refundable amount. The only way how you can recover it is by making things right and prove to the German fiscal administration that in the meantime you have successfully and correctly paid your acquisition tax in Spain. Then you get that punishment tax 3D sentence 2 back. Well, last thing to talk about is the transaction F to M, where the good goes from Madrid to Madrid, so it doesn't move at all, because at the beginning of the transaction it's already at the destination, where it also has to stay at the end of this transaction. So it's a merely internal case inside Spain, and that means no special aspects at all. Taxability, number 1, or in this case the Spanish parallel, has to be tested. F, the seller is entrepreneur, acts as such, not for nothing but for consideration. It's a delivery again, and the place is now 3.7. That's the rule here now, because during this transaction, as our sketch showed, the good does not move. It's in Madrid and stays in Madrid. It's not even moved a centimeter, because it was already at the beginning of this transaction at the place where it should also arrive under this contract. So taxable in Spain, tax exemptions and all the rest according to Spanish law. So that's it. And if somebody is already really well prepared and knows more about value-added tax, the last remark, this constellation which we have here might, under a special rule, also be treated as a so-called triangular case or triangulation case, a special rule for a specific kind of so-called chain transactions. However, that is an option. So if nobody opted for this specific rule, we don't need to take it into account. And as it is a special rule, we will later only deal with that in later chapters. So until now, this is our solution for this rather complicated, not complicated, but rather complex case. And that shall be enough for today. So enjoy that it's over, and enjoy the break till the next video comes, or till you watch the next video. And thanks and goodbye for watching this one.